Good evening, everyone, and good evening to Dr. Amira. Today, we want to present about the taxation of partnership. Our theme is audition. Partnership taxation is the concept of taxing a partnership business entity. This is our group member. The first one, the first one is AUNI ILIYA QISTINA BINTI YUSOFF. Matric number A22A0967. The second one is No Bashirah Alia binti Muhammad Azmi. Matric number A22A0981. And the third one is No SATIKADAYANA binti NURMATIAS. Matric number A22A0992. The fourth one is Nurul ADIBAH binti Muhammad RAZI. Matric number A22A0956. And the last one is Vizu A23B2524. Taxation of partnership. Introduction. A partnership taxation can be defined as a relationship between people. Partnership is the goal of operating a business and splitting profit, and agreement between people to pool their resources. Existence of partnership. A partnership is formed when two or more individuals decide to operate a business together with the aim of making profit, and each individual involved is known as a partner. The partnership operates under a specific name, which is referred to the partnership name. By a deed of partnership is commonly required to establish a partnership. There are instances where a partnership can exist without a formal deed. Certain criteria can be used to determine the existence of partnership even in the absence of a formal deed. Next one is type of partner. There are four types of partner. The first one is full or active partner, engage in the operation of the partnership, share in its earning and losses, and their income is taxed as a business sources under Section 4 of, of the ITA 1967. The second one is salary partner, function as an employee of the partnership, does not share the firm losses but may enjoy its earning, and their income from the partnership is taxed under employment sources income under Section 4B of the ITA 1967. The third one is sleeping or inactive partner. Their income is taxed as a business sources and despite not participating in the operation of the partnership. And the last one is other partners. A limited partners contribute a predetermined amount to a partnership without involvement in administration.
Okay, I will continue with the treatment of a partnership. The tax treatment of partnership in Malaysia involve evaluation each resident partner based on their share of the partnership income or losses, and charging non-resident partner income in the name of partnership, resident partner, or partnership agent. Partnership income is calculated similarly to the business income with no deduction allowed for the partner salary, interest due on capital, or private costs. The divisible income of partnership is provision adjusted income less partner earning or salaries, interest due to partner, and private costs transferred to the partnership account. As you can see, we also provide a formula on how to calculate the adjustment income.
Then, for the change in profit sharing during the year, the distribution of divisible income is done on a time-based basis prior to and following any changes in the profit sharing ratio throughout the year. And the adjusted income of each partner is calculated by adding the amounts allotted. Then, for the change in partnership, When a partner retires or joins a new partnership, the old partnership ceases and a new one begins. If at least one partner from the previous partnership is also a partner in the new partnership, and the trade nature is nearly identical, partner in both old and new partnerships has a single ongoing source of income. After that, for the partnership capital allowance is claimed at the end of the base period for expenses on a partnership on fixed assets used for business. The calculation is based on the individual partner's profit sharing ratio at the end of the assessment year. Partners who are partners at the end of the assessment year and thus based on their share of this divisible income will receive capital allowance and balancing charges.
Okay, I would like to talk about tax treatment of partnership losses. They must report their share of the partnership income or loss on their personal income tax return. According to Malaysia Tax Law, Section 44(2) of the Income Tax Act 1967, a partner can claim a partnership loss as a current year business loss. This means that the partnership can deduct the loss from their income in the same year that the loss occurred. Accounting record for a sole proprietorship or partnership. Those are type of business organizations where the owner have unlimited personal liability for the business. This means that they are personally responsible for the debt and obligation of the business and their personal assets such as their house or car. Therefore, it is very important for owner to maintain educate document and record for the business transactions such as invoice receipt. This document and record can help them to determine the profit or loss of business, to file the tax return and to defend themselves in case of any dispute or audit. According to the Malaysia tax law and accounting standard, the owner must follow some rule and guideline for keeping the record and book of account. This is the example of record.
And then I will present about treatment of certain transactions. The text outlines the process of handling certain transactions, including minor outlays, loans and overdraft, store locations, and sales. It emphasizes the importance of recording and documenting expenses such as parking and taxi fares, and dividing costs between personal and professional use. It also mentions the need for tax adjustments when calculating a business adjusted income as well as the documentation of personal and business expenses. Last but not least, the, the consequences if sufficient records are not kept. The Director General of Inland Revenue (DGIR) can mandate a partnership or a single proprietorship to pay for professional accountant audits, chargeable income, and face legal action including fines, imprisonment, or both.
Besides the notes, we also provide a video animation that related to this topic types of partnership. In this video, there are 5 subtopics that has been mentioned, such as definition, type of partner, changes in profit sharing, changes of partnership, and tax treatment.
Okay, this is the link for quiz. You can join and practice to more understanding. Before we start about the analysis critical, I will explain about the connection between this case, the Wira Muda case and the taxation of partnership. The case affect how the income or loss of a partnership is computed and taxed. The Wira Muda case is landmark ruling by the federal court that declared that compensation received for the forced acquisition of land is not taxable. This decision has significant implication of partnership taxation as it may affect the computation of the partnership income or loss.
Then I will proceed to the current issue. The Wira Muda case is a landmark ruling by the Federal Court in Malaysia declaring that compensation received for their post acquisition of land is not taxable. This decision has significant implications for partnership taxation and may influence future tax laws and legal interpretations of partnership revenue and compensation. The case involved the taxpayer receiving compensation for the post-acquisition of land, which was then made liable to income tax under Section 4C by the Inland Revenue Board (IRB). The taxpayer contested the decision, arguing that Section 4C was illegal because it violated Article 13 in bracket 2 of the Federal Constitution, which guarantees the right to adequate compensation for the compulsory acquisition of land.
The Court of Appeal and Federal Court had previously ruled in favor taxpayer in similar cases, leading to the inclusion of Section 4C in Finance Act of 2040. However, the Federal Court decision in Wiramuda case overturned this provision, citing the supremacy of federal constitution over law enacted by Parliament.
This decision has far-reaching implications for partnership taxation and may lead to reassessment of partnership income and a nuanced interpretation of existing tax legislation. It may also prompt policymakers and tax experts to closely examine the case and consider how it may impact tax law and procedures related to a partnership income.
In light of this decision, taxpayers may have more options when structuring their financial agreement, especially in partnership agreement. However, it is important for taxpayers to exercise caution and seek professional counsel to ensure compliance with the particular and ramification of the Wiramuda case.
The decision may also prompt the Inland Revenue Board (IRB) in Malaysia to review tax law and policy related to partnership income. Tax authorities often have to adjust their procedures and enforcement tactics when judicial ruling change how specific transactions are treated tax-wise. In conclusion, the Wiramuda case represents a significant change in the taxation landscape in Malaysia, with implications for partnership taxation and future laws. Taxpayers should stay informed about updates and or explanation from tax authorities and seek professional advice to navigate this new theory effectively. That's all from our group. Thank you.